Futures contract is an agreement for a commodity delivery at a fixed price in the future. Futures contract seller enters into commitments to sell an underlying asset at an agreed date. A buyer assumes an obligation to buy the contract at a specified date. Both obligations are related to a standard contract size of an asset which will be delivered at a certain date and at a price fixed at the moment of concluding a contract. The most widespread futures are gas, crude oil, auto fuel, gold, wheat, currency, steel, cotton, and wood. Every day, thousands of market players trade futures contracts. All of them try to gain profit by speculating futures, buying them low and selling high. Futures trading is available on futures exchanges. The most famous are NYMEX, New York Mercantile Exchange, CBOT, Chicago Board of Trade, CME, Chicago Mercantile Exchange, IPE, International Petroleum Exchange, LIFFE, London International Financial Futures Exchange, and LME, London Metals Exchange. Futures trading is much the same as currency trading. The similar methods of technical and fundamental analysis are applied to futures markets. There are the same indicators, charts, and rules for placing orders. However, futures trading has some distinctive features. Forex currency pair trade can remain open forever. It means that having once bought pounds for US dollars, you can keep the position open for months, even years. Futures contract has its expiration date. If a trader does not exit the position, it will be closed compulsory at the price of the last trading day and hour specified under the futures contract. Futures code consists of several parts. The first characters stand for the asset of the contract, for example, gas. The next symbols indicate the delivery month and the year. For instance, NGQ0 is gas futures. NG stands for natural gas. Q for August, 0 for 2010. The most liquid futures contract is the closest one to the expiry date, as its value almost matches the real price, minimizing the likelihood of a price spike. Futures trading is available only on exchanges with a certain buyer and seller establishing price quotes. Every quote has not only a price, but volume as well. That is why all futures brokers have identical price quotes in their trading platforms. The size of a futures contract is strictly standardized by the futures market. The market sets the quantity and the quality of a given commodity under a futures contract. Futures price quotes are unambiguous and unified for the entire world. Recently, forex brokers have begun to offer futures trading as well. The correct name of this financial instrument on forex is Contract for Difference on Futures, or CFD. Forex traders have no chance to influence on the price of a CFD on futures. They just accept it by speculating on the difference between the rates.